what I want to go and have a quick look at is a few different areas. I'm not going to spend ages on all of these areas, but we'll have a little bit of time, and people have got questions or points on it, chuck them in the chat. But what I wanted to talk about is understanding what your edge is, and this comes down to understanding the types of trades that you take, where volatility provides you different opportunities, or provides you opportunities that you may well normally have but become much more frequent. So it's about kind of understanding the profile of trade scope, trade opportunity, and how you go about dealing with that and adapting to it. If you've not traded a great deal of volatility before, that's fine. Now's the time to try and adapt, but also this is a great opportunity to learn, because next time you get the volatility back, as it has been over the last few weeks, you're going to be so much better equipped. You're going to be more ready for it, more able to sort of know what's going to suit you and how you can start trading some of these things. I always talk about as well the kind of idea that, and I think there's a lot of kind of throwaway phrases and basic misconceptions about volatility. And sorry, I was just saw a message from there. And the kind of way that people talk about it. And I think often there's these kind of generalized phrases that don't necessarily fit together. And you have to kind of sort of balance one against the other. Particularly when we talk about the kind of idea of patience and then high frequency of opportunity, and the kind of contrast between the two, that it's hard to be patient when there's lots of opportunity, but equally being patient when there is lots of opportunity is also what pays you, and the kind of difference or disparity between the two of those. We'll look at expectation management as well. This is something I think so important when people recognize where the opportunity is in trades and how much can really be taken out of trades. Too often people get so used to taking trades for what they're used to. This is what I normally get out of a trade. And so they're very quick to kind of snatch that. And just looking at things from a sort of expectation point of view, not that's a decent P&L point of view, is massively helpful. And we'll come and look at particularly in the S&P over the last few days. And I think the distinct difference between, and I don't think I've put an oil daily chart up, but if you look at oil on a daily and S&P on a daily, there's quite a distinct difference between the S&P big picture view, which hasn't fully changed yet, and the oil one, which looks like it has. And the sort of flexibility, particularly in the S&P, to be able to go, right, it looks bearish, but actually today's a buy. It looks bullish now, but actually today's a sell, whilst we're still working out where exactly we're going in particular in the S&P. So just sort of try and highlight a few things to get people thinking about. And the first thing is trade payout. Now, the first thing that people always think when volatility goes up is, your risk goes up. And yeah, it does. That if you look at this in terms of absolute number of ticks risk that you're taking on a trade, number of ticks risk that you take is probably going to increase. You have to then adapt, and that's part of dealing with volatility. That anybody who's thinking I'm going to have a consistent number of ticks stop is immediately going to get themselves into trouble, because the frequency with which you get stopped out is going to go way up because the size of the stop is too small. So yes, the size of your stop is going to have to increase. I kind of try to illustrate that on the little sort of graph, which I've just drawn as an illustration on the right, that if you look at this in terms of ticks, if the red line is the size of stop that you require, what you often find is that the size of stop, yes, will go up. So you are taking on more risk within a day or on any one trade. And as such, you are perhaps going to have to reduce the size with which you trade. But there's a relationship between the size of stop you take and the amount that you can get out of the trade. And the risk reward on a trade, I feel, actually generally goes up in that stops, yes, let's use an example that maybe your stop has to double in terms of being able to deal with that additional volatility. Quite possibly, though, the payout on trades when they work is going to triple, quadruple, because markets have a greater ability to overextend. They will put in these larger moves. And as volatility picks up, more and more people get shaken out of positions. So you start breaking through more significant daily and hourly levels. And therefore, each stage of the move creates larger movements. Whereas your stop doesn't necessarily have to increase dramatically. I'll give you an example of this in a moment. Often because when volatility increases, markets become a little bit clearer on basic things. So your ability to define your stop, the point where you're wrong in this instant, and this will come on to the frequency argument in a bit. But the point of being able to say, right, in this instant, I am wrong here, is often not a great deal different to a similar trade when volatility is lower. The difference when volatility is lower is that the point where you're wrong is often a little bit less clear or easy to define, and perhaps has to take in a more number of ticks just to be sure that you're not wrong on the trade. So where volatility helps people out is that if you can deal with, yes, accepting that you will take a bigger tick stop, you've also got the greater opportunity that you're going to take a much larger tick winner, i.e. your risk reward on trades can actually increase. Yes, you get stopped out, it's going to cost you more, but your payout is going to be multiples of that additional. I'll give you a little example of this. I've not got examples to kind of prove everything. If you look at, this is oil, similar kind of structure, a kind of flag with what I like to call a sort of trigger for the break, rather than just simply going on the flag break. I'm always looking at a trade like this, that once you break through the 73.62 in this example, the 80.19 in the example on the left, the 2 days, one was the 26th of November, was the one on the right. On the left is the 16th of November. So pre the volatility, you started to see a little bit on the Austria lockdown, but not that much. The 26th, which, yes, granted, was the day after Thanksgiving, you got much more volatility as the Omicron story started to develop further and further and further. Now, if you look at these two trades, the kind of concept of the trade is very similar, that you're going to look to try and sell through that trigger and looking then for a progression of move. On the 16th, if you're looking at this one was played out as you came into the oil sort of pit session, and you're looking for a move basically to the low of the day, which was around about 79.66. So this gives you about a 60 tick target, 55 tick target. Now your risk's not that easily defined on this trade. Your risk is probably around 20 ticks. You're going to have to go above the top of this range. So you're taking on around about a 20 tick risk for around about 55 tick winner on this trade. Equally, the move itself takes a considerable amount of time. You get 3 or 4 minutes down, another 4 or 5 minute consolidation, and then a grind down. So it takes around 15 minutes, at which point there's multiple phases of that you could question whether this move is really going or not. Whereas when the volatility increases, because you're starting to push through more significant levels, at this point in oil, for example, you were below the 74.60, which is quite a key daily level. So you've got the greater scope of movement down. Similar type trade here then, at a better defined risk. If you're selling it through 62, yes, arguably you could put your stop above the range, but you've got a much clearer reference point that once you're through 74, you can sell 62. You could argue that you actually could take a smaller, if not the same size stop. And in this situation, you're extracting over 100 ticks in a straight line. So even without a target, you're still going to be able to get out when the one time frame ends. So getting you out near the lows, around about 80, 85 ticks up on the trade with a similar risk. Even if you took the stop all the way up here, you're still only taking a 30 tick risk. So it's a 50% increase in risk tick wise, but it's a 100% increase in P&L, and that all profit on the trade, potential profit on the trade. Now, that's something I think people need to always remember when they're sort of looking at trades and what they're going to get out of trades. Stops can often be better defined. I'm not saying that you need to then up your size, because of course, when they run away from you, they will run away from you quicker. But you can get into a trade. Once your stop's defined, there is the ability to still be able to take this trade on with reasonably similar to size to what you might normally take a trade on anyway. So that's the first bit on payout. The next bit's on your ability to categorize your trades. And for those who are looking at this thinking, yeah, this is time to pick up some learning here. Absolutely, you need to be looking at this and categorizing trades that are working better, trying to work out the types of trades that are easier to execute, are providing you much greater opportunities in this period of time than they might ordinarily. The easy example of this is perhaps something like a breakout trade. Breakout trades, when volatility goes up, generally will work more because you've got that greater energy, so that when you reach a level, you can drive through it, particularly in the direction of the trend, in the direction of the current movement. So what you want to be trying to work on here from a debriefing perspective, more so than anything else, is to really categorize not just the types of trades that you're taking, because I would assume that you're going to be taking very similar trades now than you would at any other time of day or any other period environment within the market. But the point here being, you've got to work out the types of trades that you can take that are working, and what's working better now than it has done previously, what's not. That way you're teaching yourself how to recognize that environmental shift and recognize what it is that you need to be perhaps dropping out of your trading repertoire on any one day, what it is that you need to be bringing in on certain days. So it's all about sort of, trying to think about your own style and what you do and adapting that to the environment. Adapting the way that you go about thinking about trades and executing your trades. If you're somebody who is typically more of a sort of a reversal, play it back into the range type trader, it doesn't mean that these trades don't work, but it might mean that the way you take the trades on needs to be adapted. And there's going to be less about a market that runs out of energy and then rolls back up, and more about a market that has this exhaustion of energy, which then essentially does the same job much quicker and then rolls back up. So those trades and the kind of concept of a sort of failure to continue a move reversal is absolutely still there. It just may well mean that they're going to appear in a slightly different light, that your way of taking a trade on like that may need to be adapted slightly, and it could end up leading, I think in many cases, to a more sort of breakout style, whereby you get the exhaustion down, consolidate, and then play that as a break, because that way you get an easier way of defining your risk. The other thing that I think is always important to understand with volatility is what I call a more pure auction. So what I mean by this is that markets will trade more clearly to points. You won't get this kind of fudging through levels and this kind of low energy floating sideways situations. You get a much easier feedback. The market hits a level and reacts, or it hits a level and goes through it. That way, you get much more clarity as to where you're right, where you're wrong. And this also can feed into the way that you take trades on. That's why I feel that a breakout style gets used a lot more heavily, because the fact you do get that immediate feedback, that you get to a point where you think the break's coming, it either does or it doesn't. And it's not to say that they're going to happen more or they're going to work more frequently. It's more to say that you get that feedback immediately, so you don't have to sit there thinking, played the break and it's not really gone, not much has happened, you're able to sort of look at it and say, right, this is where it's going to happen. Has it got the velocity to do it? Yep. Hit it and it goes, or it doesn't. And very quickly you realize this isn't a goer, and you can get out. Going back to what we just talked about, you may not need to be taking on a huge amount of risk in order to be doing that type of thing.